market is seeing that the economy is not weak.
We're getting to a point where equity risk premiums are incredibly narrow.
I don't know what to expect, but I'm not really sure if markets really know what to expect. I think that creates some volatility.
There's quite a lot of momentum still to be had, particularly in the first half of next year.
As goes January, so goes the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
6 a.m. here in New York, 11 a.m. in London, 12 midnight in Auckland, New Zealand. Happy New Year to our audiences worldwide. This is Bloomberg Surveillance. I'm Romain Bostic alongside Kriti Gupta. John, Lisa, and Anne-Marie have the day off. And Kriti, an interesting punctuation mark to what has been a phenomenal year for equity markets across the globe here. The S&P here on the U.S. sitting on right now a 24% gain on the year in futures, at least here on this particular Tuesday, pointing to a slightly higher open.
Maybe setting us up for some sort of reckoning in 2025, not just in the stock market, in the bond market, certainly in the currency market as well, Romain. Absolutely here, but we talk about the tone to end the year here. You look at the year-to-date gains that we've seen on the S&P, that we've seen on the NASDAQ, that we've seen, quite frankly, on all of the indices around the world, but that performance did not necessarily hold here into December and into the fourth quarter. Those gains, losses here on the month and on the quarter, as a lot of people do start to look as to what's coming up in 2025. Coming up here on Bloomberg Surveillance on this December 31st, the conversation coming up in just a second with John Stoltzfus, one of the most bullish folks on Wall Street, over at Oppenheimer, talking about his street-high S&P price target for 2025. Darwei Kong over at DWS going to be joining us to talk about the phenomenal rally that we saw this year in gold in Kona, Haque, over at ED&F, man, on, well, the somewhat less phenomenal rally for coffee prices, at least if you are a coffee drinker. But Kriti, let's begin this hour with a quick check here on what's going on with S&P futures as we close out a record year for U.S. equities, 57 record highs for the S&P so far this year. The punctuation mark coming on December 6th, of course, when it closed out at right around 6,090. Peeling back just a little bit from that, looks like it is going to open the day, if these futures numbers hold, just below that 6,000 mark. Euro dollar unchanged on the day. Your 10-year yield relatively unchanged as well, camped out around 4.5. And we're going to talk a lot today about what's going on in the commodity space. WTI crude prices camped out right now at about $72 a barrel. All right, let's talk a little bit here about the outlook for equities, particularly as a lot of people look at this bull market and wonder whether it can continue into 2025. Price targets are coming in for the new year, and we should point out price targets for the past year, well, they were light. John Stoltzfus, though, he was always bullish, and he had a good eye on what he saw and what he thought we would get in 2024. And now he's out with his note for 2025, saying that the bull market has more room to run, writing that the pivot to easier monetary policy, we believe, supports our view that the market for U.S. equities is still mid-cycle. And he says that the technology-led double-digit gains of the large-cap stocks over the first 3 quarters of 2024 likely to broaden out to other sectors, styles, and market caps in 2025. Pleased to say that John joins us right now here on the big program, kicking us off here on this December 31st. Happy New Year to you, John. And let's talk about those forecasts going forward. What supports some of these targets? I'm seeing targets come in now, including yours, into the 6s, into the 7,000s for the S&P 500. Is this all earnings driven, or are we going to see some multiple expansion as a part of that as well?
Romain, great to be on surveillance this morning with you, and Happy New Year to you and the whole Bloomberg team as well. I must say that with us, it's a combination. It's always, you want to see revenue growth, you want to see earnings growth. That's what matters most to the market. But I think overall, there's room for multiple expansion to play a role in here. The private investor over the years, I've been in this business for 41 years, has changed a lot over the years. And with the what has taken effect in terms of retirement planning over the course of the last 40 years, in which we've seen defined benefit pension plans go by the wayside, Social Security, the amount of income that it can provide, or what percentage it provides an individual of income during retirement, means people have to invest more. So we think many private investors today, instead of investing in 5 stocks for the actionable idea of the day, are investing much like institutions would for intermediate to longer term goals. And we think that supports higher multiples. While on the other hand, we think the effects of technology on all 11 sectors that has been shown since the financial crisis right up to date through the pandemic, and now with AI in the process, offers a lot of opportunity here to see equities move higher.
We'll expand a little bit here on that theme of AI. That was a big part of the trade that we saw in the market, certainly in the first half of the year. A lot of questions, though, towards the second half of the year about when we start to see the material gains from that on the bottom line and on the top line, for that matter, as well. We see that in 2025, John?
Yeah, I think we'll begin to see it more and more. I think this year it's been primarily the amount of investment that has been made in AI, both from within the technology sector itself, but in the other sectors by managements that want to remain very vibrant and effective in attracting investors' attention in terms of creating greater efficiencies for revenue and earnings growth. And on the other hand, we think it's the consumer is going to be a big part of the upgrade that began in this year and likely will gain some traction in 2025 and on forward. But all this stuff takes a bit of time. But for investors, you know, who have patience, are diversified, know what they own, why they own it, and have right-sized expectations about how different asset classes, different sectors, cyclicals versus defensive, et cetera, operate. This looks like a time of both opportunity and risk. And the main thing is to have some tolerance for fluctuation and a tolerance for risk that is realistic and right-sized.
John, how much of the bull case is dependent on capital flows from the rest of the world? In the absence of kind of economic resilience in Europe or China, do you see international investors bolstering the U.S. market, maybe more so than domestic?
Gosh, you know, that's an awfully good question. I think over the years we've seen private investors from abroad increase their exposure to the U.S. A lot of that because of the influence of the technology sector with the innovation that occurs here in the design stage of technology. But in addition to that, you know, the factor is in an uncertain world, the U.S. strength of the U.S. dollar also attracts foreign investors to invest in the U.S. While meantime, central banks and sovereign wealth funds may actually stay at home, many of those foreign funds. We think it's the individuals will continue to invest for diversification in the U.S.
But John, you mentioned that point of the dollar, that it attracts international investors. Doesn't it disincentivize that bid? So an investor in, say, Japan, hypothetically, that maybe wanted that realm of safety or kind of innovative technological exposure, maybe looks at the strength of the dollar and in 3 months' time and says, actually, this isn't worth it?
Well, actually, we would have to say that the strength of the dollar is relative. And I think with the dollar's strength where it is right now, for instance, it almost disincentivizes U.S. investors from investing abroad because the foreign currencies are weaker versus the U.S. dollar. On the other hand, for foreign investors where their currency is weak versus the U.S., investment in the U.S. enhances dividends, enhances gains, because investing in a stronger currency helps your performance if you're a foreign investor with a weaker currency when you reconcile your trades, or you don't get a loss in translation, but a gaining in translation.
I am curious, John, here, if you can talk a little bit here about how some of the policy decisions that we're expecting out of Washington could affect the performance of financial markets. And I want to start specifically on the tariff side, because there are some concerns about the bottom line effects on corporations and obviously the inflationary effects on consumers.
I'd have to say, Romaine, that the greatest concern relating to tariffs, of course, is on the traditional sense of tariffs. Everybody can remember tariffs presaging the Great Depression and all. But the effect of tariffs during the first Trump administration and during the Biden administration, when he actually kept many of the Trump tariffs and even increased them, was not anywhere near as of concern as might have been expected. We think the idea of some of the numbers that are thrown around by the president-elect in terms of what he might impose on tariffs, much of this we would think is part of that art of the deal approach that the president-elect takes when negotiating. But the other side of it is, if you consider the U.S. economy versus producing economies of all the goods that our consumers buy, both businesses, consumers, as well as individuals, we're buyers of size. And so we're a very attractive place to sell your goods to, which might mean there's more wiggle room for countries that want to sell into our country or export goods to us to win our import dollars, so to speak. And we think it'll be interesting to see how that works out. But we think most of the talk on the tariffs, based on the cabinet and the experience of the cabinet, as well as the president's experience after having had 4 years in office prior to this, we think it'll be more of the bark will be louder and much more create more fear than the actual bite. And we also think the negotiations will probably work out better because countries are going to look to want to keep the U.S. as a major source of their exports.
John, great stuff as always insightful all year long, and we expect that as well in 2025. Have a happy new year. John Stoltzfus there over at Oppenheimer, a Bloomberg survey showing that right now the median price target right now for the S&P to end next year right around 6,600. The highest estimate in that survey came from the man we were just talking to, 7,100, Creedy. We talk about this idea here of whether expectations heading into 2025 are going to match up in the same way that we saw with those low to high expectations in 2024. All right, let's get you an update on some of the stories going on elsewhere this morning. Let's get the Bloomberg brief. Yahaira Jaquez is standing by. Yahaira.
Hi, Romaine. The U.S. Treasury Department said it was hacked earlier this month by Chinese-backed cyber attackers. The department said the incident led to unauthorized accessing of workstations and unclassified documents. The hackers gained access via a third-party software provider with contracts with the government. The Chinese embassy in Washington called the claims, quote, smear attacks against China without any factual basis. Meanwhile, the Tel Aviv Stock Exchange is planning to move its trading days to Monday to Friday from its current operating week of Sunday through Thursday. The change will happen in early 2026, and trading will end at 2 p.m. on Fridays in order to allow for observance of the Sabbath. The finance minister says it will align Israel with other global capital markets and strengthen its connection to the world. And football star Lionel Messi carried out an initial public offering of his real estate properties, valuing the portfolio at $232 million. The company, called Edificio Ross Tower Socini, has been listed as a real estate investment trust. The portfolio includes 7 hotels, commercial real estate, and homes, but has posted losses in both 2022 and 2023. That's your Bloomberg Brief. Romaine?
All right, our thanks there to Yahaira here. A quick check on the markets. U.S. futures pointing to a slightly higher open here in the United States. Asia trade, though, thin on the day. A lot of markets around the world already closed for the New Year's Eve holiday. A recap of some of the big movers that we've seen across asset classes on a year-to-date basis, and that includes gold nearing historic gains to close out the year.
Gold offers more reasons for investors to be long right now. When we think about the highest risks associated with tariff escalations, with debt fears, we think this can take prices even above our 3,000 forecast.
A 27% advance on gold, a conversation up ahead as to what keeps that rally going into next year. You're watching Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. Futures here in the United States pointing to a slightly higher open here on the final trading day of the year. And S&P 500 looks like it's going to be camped out right below that 6,000 level, just a little bit shy of the all-time high hit back on December 6th of 6,090. Euro dollar relatively unchanged on the day. Your 10-year yield camped out around that 4.5 level. A lot of speculation about where we go next, up or down, Creedy. And I don't know if next year, if the big story is going to be about the FX market, the bond market, or maybe commodities, what could potentially drive markets worldwide next year, Creedy.
Yeah, I'm sure we're going to see a little bit of all of that, given especially that currency story we were just talking about in the last block there with John over at Oppenheimer, talking about this idea that if you're looking for a haven and the dollar serves that role, well, does gold as well? That might be the story for next year. Absolutely. And we talk about gold. It has had a phenomenal year, a 27% gain year to date. Right now, futures pointing to a slightly mild gains here on a daily basis, but that's still going to set it up for the best year in at least 14 years. One of the best performing commodities, certainly in the metals market here. And a big question right now about some of those historic gains. That's under surveillance this morning.
Gold offers more reasons for investors to be long right now. And really what I think the dominant driver has been is this structural support from central bank buying. This is really the primary driver, and the safe haven notion, the hedge against inflation, we think goes on top of it. In fact, when we think about the highest risks associated with tariff escalations, with debt fears, we think this can take prices even above our 3,000 forecast.
And we continue this conversation about gold, continuing that tear up 27%. And as you just heard there, some of that driven by monetary policy easing, some of that driven by rising geopolitical risk, some of that driven by central bank purchasing. You put that all together, you get the gains for the year. But what about 2025? Darwei Kung over at DWS, he's writing in his recent note that his forecast for gold for end of year 2025, it actually reflects a view that we still see a rise, but at a more modest pace. Darwei is, of course, managing director over at DWS Investment Management and joins us right now to talk a little bit more about this run. And I mean, we talk about how high and how steep that chart was for a good portion of the year. Some of that, of course, has leveled off, Darwei. And I saw back, I think it was in maybe September, you guys did kind of reduce your general overweight stance just a little bit here. Where do you stand right now? You stay neutral on gold, you go back overweight, or you underweight it?
Right now, we're neutral, and we anticipate we'll go back to overweight again in 2025. We do see the price, our forecast right now for the end of the year 2025. At the end of 2025, we see $2,800 for gold, adjusting down from $2,940. The big part of that adjustment is we changed our view regarding where the terminal rate will be for the Fed. At the end of September into October, we saw the peak for gold price touching near $2,800 per ounce. And that really reflected the view that the Fed will cut to a terminal rate near 3 to 3.5%. Since then, we've seen much more conservative, hawkish view from the Fed with potential return of inflation. And that's the key for us in terms of where the Fed will go from here. At this point, we see more likely the Fed terminal rate to be around 4% than 3%, and that's why we adjusted our gold forecast. And that said, there's a lot of uncertainties, and we think those uncertainties will make gold more attractive for investors.
Well, that's what I'm curious about, though, too. I mean, we kind of have to break this up as to why certain people buy gold. For some people, it is kind of that protection against risk. Obviously, you have to deal with the inflation implications of holding something like gold as well. And then, of course, you have a lot of other purposes, people allocating to portfolios here. What is going to be the dominant driver, do you think, of buying and selling of gold next year?
I do think gold as an asset class, as a diversifier, will be a key theme for 2025. We've seen equity market going up significantly, although gold performance has been very strong in 2024. Equity market certainly has done its share as well. And we've seen the rise of fixed income market as well. In 2025, though, we do anticipate market uncertainties, policy uncertainties coming in with the new administration, the talk of tariffs, and how that might impact global trade. All those type of risks could potentially change the valuation for the equity market. And Also, for the fixed income market, if the Fed stays hawkish, potentially we may see yield curves actually steepen further. Actually, we may see higher yield from here as well. Those type of factors, I think, really makes the investment decision very difficult. We believe gold would be in the best place to hold value against the background of any potential market reset in 2025.
So, Darwei, we talked there a little bit about the bull cases for gold there. Let's talk about the bear cases, specifically given that so much of the rally in early 2024 was driven by retail demand in China as an alternative to some of the own kind of property crises that they had in that part of the world. We're now seeing a flow of stimulus from China. We're trying to see the Chinese consumer get back up on their feet. Does that help or hurt the case for gold?
Well, that's a very interesting question. I think the strong demand that we saw from Chinese individual investors came at early part of 2024. And during that time, we've seen the property market really perform very poorly. At the same time, equity market in China was also performed very poorly. That lack of consumer confidence, as well as concern about how to protect the investment, really made gold very attractive. Since then, I think the interest from the investor side actually have shifted ex-China. One thing we do like about gold, and I think this was mentioned earlier in the segment as well, central bank buying has been very strong. 2023 was an exceptional year. 24 has slowed down somewhat, but the big difference was Chinese PBOC did not participate in gold buying in the second and third quarter. But if you look at the data from first and fourth quarter, where PBOC has engaged in buying gold, the pace of buying for central bank actually matches 23. If that were to continue, and we anticipate that trend to continue, actually, the devalorization to continue, that will be a very strong floor support for gold price.
Darwei, I have to ask you a little bit of a left field question here. So many people say that the very cases for gold, inflation, risk protection, the uncertainty of 2025, especially with the new administration, are the same reasons that you would buy, say, Bitcoin, for example. Could the rise of Bitcoin and what you've seen in this year undermine the case for gold or even provide an alternative to gold? Is that a viable argument?
It's certainly an argument, and we've seen some anecdotal data that would suggest maybe some individual investors certainly have shifted their interest from gold to other digital currency, and Bitcoin being the biggest beneficiary of that. That being said, I think the perception of gold versus Bitcoin is still very different in terms of value. And in some cases, I think also use of Bitcoin in particular, we see a lot of people concerned about legitimacy of Bitcoin, especially when it comes to potential financial crimes and so on. Those concerns for institutions and central banks will not change. I think for certain part of the market, they will always consider the gold as the quote-unquote gold standard for value preservation. So we don't anticipate that part to change. The individual consumers, on the other hand, investors, on the other hand, I think that trend will continue to change and benefit Bitcoin. We do have a positive view on Bitcoin as well in our forecast, and that's really very much driven by just increased demand we see from, in particular, U.S. portfolios.
All right, Darwei, got to leave it there. Bitcoin right now camped out right around that 9,400 level. Spot gold 2,600. Darwei Kung, managing partner over at DWS, talking about that 27% rally that we've seen in gold futures, slightly higher here this morning on the final trading day of the year, and a big setup going into 2025. We're going to talk about commodities a little bit later because, believe it or not, gold was not the best performing commodity this year. That belongs to cocoa. That belongs to coffee. That conversation coming up in just a bit. Of course, if you want to find the best and brightest minds in the world of finance, you're going to find them right here on Bloomberg Surveillance. A whole host of interviews have taken place right in this studio all year long, and we're going to recap some of those when we come back. I'll sit down with San Francisco Fed President Mary Daly. Highlights from that recent interview coming up next. You're watching Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. U.S. futures pointing to a slightly higher open here on the final trading day of the year, December 31st, here in the United States, 0.3% higher. A punctuation mark, a somewhat middling punctuation mark, if you will, on what has been a phenomenal year. 20% plus gains for both the S&P and the NASDAQ this year. The Russell up about 10% on the year. The Dow up about 12 to 13% here. Of course, the biggest gainers on a year-to-date basis, well, you're going to find that in the Mag 7. They are responsible for almost 70% of the gains this year in the S&P 500. Under surveillance this morning, we want to take a look here at the U.S. Treasury confirming that it was hacked earlier this month by a Chinese state-sponsored actor that breached the department's third-party software service. Now, the hacker gained remote access to certain Treasury workstations and various unclassified documents. Kriti, this is one of the most read stories on the Bloomberg terminal. Not only questions here about this particular hack, but for how long it's been going on and sort of what this means for the relationship between the U.S. and China.
And we've already seen that come, of course, to a little bit of a pinnacle here where the Chinese embassy in Washington is already saying this has become just the latest in a series of accusations from the American government to the Chinese government that this is something that they use, cyber warfare at the end of the day, of course, denying that this had any part in it. We should really point out, though, that this Chinese hacker at this moment, from what we know, is not associated with the Chinese government. We're still waiting on details around that. But Romaine, this is something that is bringing a little bit of a scare factor, given that the contractor that they talked about, Beyond Trust, is also utilized with contracts for about $4 million with the likes of the Department of Defense, the Veteran Affairs Office, and several others.
Mm-hmm. Yeah, and it should be pointed out, the U.S. actually raised this issue, apparently, back during those meetings in Lima, Peru. So this is something that, of course, the U.S. has known about, now coming to light here in the public and raising a lot of questions about just what information the Chinese did obtain. Meanwhile, in other news out there, President Joe Biden has announced a $5.9 billion aid package to Ukraine, and that includes more than $1 billion in direct military aid and billions more in budget support. Now, this announcement comes ahead of an expected policy shift with the incoming administration of Donald Trump, who is set to be inaugurated on January 20th. And this is an interesting development, Kriti, because obviously we've seen the Biden administration try to rush through a few sort of last-minute funding and aid supportive measures for Ukraine before Biden leaves, I assume with the expectation that these things won't be supported by President Trump.
Yeah, about $1.9 billion of that total, about $6 billion coming from that presidential authority, that drawdown that actually takes out U.S. stockpiles. This isn't additional, say, military aid. It's coming from a U.S. stockpile. And this is the scare factor, Romaine. I'm sitting here in London, and this is what we talk about almost every day, this idea that in January, come January 20th, suddenly NATO, some of these European nations really have to increase some of that defense spending. They can't rely on that American support, and not just defense spending for their own countries, but defense spending for Ukraine as well. You can see Biden doing anything he can help, but come January 20th, I don't know much more of what he can do.
Yeah, it's been pretty clear here exactly what Trump plans to do, at least what he said on the campaign trail. And of course, the blueprints coming out of Project 2025 does not necessarily bode well for that fight, Kriti. And of course, a lot of this, at least here in the U.S., is actually being pushed by, what we are calling over here the first buddy, basically the man who kind of helped get President Trump elected. Elon Musk has now turned his attention to Europe and specifically Germany. And in fact, just a little bit earlier, we heard from German Chancellor Olaf Scholz denouncing, not by name, but basically making a mention of Elon Musk in his New Year's address for Musk's support of the country's far-right party in the upcoming elections. This is the AfD. Musk has repeatedly praised the party, writing an endorsement in a German newspaper earlier this week. And of course, we should point out this is a relatively far right-wing party, and at least 3 chapters of that party are designated as extremist organizations within Germany here. So a little bit of a tit for tat here between, I don't know if we call him a lame duck, president there in Olaf Scholz and Elon Musk, of course, who had an outsized influence over the U.S. election, Kriti.
Yeah, I think it's fair to call him a lame duck, especially given that we have those German elections, February 23rd, I believe, in 2025. And just for our global audience, the AfD party, yes, it's far right, but they're also advocating for things like getting rid of the euro, pulling apart from the EU, had a very vocal conversation interview with our very own Oliver Crook right here in Europe, talking about the fact that the EU is to blame for Germany's economic woes. So we'll see if that has some legs in 2025.
All right, a story to watch here among a lot of stories that we're keeping an eye on today. And we go back to some of the stories from earlier this year, the unknowns surrounding the Fed's path forward in the new year, projections ranging from more rate cuts to potential hikes. We had to sit down with San Francisco Fed President Mary Daly on Bloomberg Surveillance earlier this month. Here's what she had to say.
It's about the data. It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together. And really, as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today, I feel like we've got policy in a good place, the economy's in a good place, and we are prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened, and you look at the data, and what's happened is that there's two things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be. And we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. But then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress has just slowed relative to what we had wanted. But that's a typical pattern. It's bumpy. As you get to the, from 2.5 or 2.8 to 2, it's just a bumpy path. Go ahead, please.
So at the same time, some people were wondering if there was this stickiness, and I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. Remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. Was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. We've practiced that where with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
From September, the expectation in the markets was going into every meeting that you'd be cutting. Has that changed now? Should the expectation be that you won't be doing anything at any particular meeting? And from that question flows a second question. What are the criteria that you need to see to decide to go back to cutting rates?
Well, as you saw from the SEP, the median projection is 2 rate cuts next year. So that's already not every meeting or every other meeting. That's 2 rate cuts. I was very comfortable with that median. That makes sense to me. But we have to remain agile. I mean, the thing that's got us here is being resolute to achieve our dual mandate goals. Price stability was our focus when inflation was very high. The employment has come into the frame so that we're focused on both. But then we also have to be agile. The world is uncertain, so we pencil in 2. And, as that estimate or that projection gets further from when we made it, the accuracy of it probably falls. And so we're just going to continually take in more information, consider it, and every meeting, your listeners should think about this, every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
When we went into the cutting cycle, you were out front and saying you were concerned about the labor market and that we needed to make sure that we didn't lose the gains that we had. Now, Absolutely. At least coming out of Chairman Powell's press conference, it sounds like the focus has shifted to inflation again. Are you comfortable with that as this new phase that he he's talking about?
Well, I think of it as a new phase as well, and I would characterize it slightly differently. I would say that for a long time, a persistent amount of time, protracted, we were focused almost entirely on inflation. That's because the labor market was quite robust and inflation was 7, 6, 5. That was the right way to focus. Then the labor market came into the frame. That didn't mean we turned our focus totally to it. It just meant that after a long period of focusing only on inflation, we were now focused on both. I think that is still the case, but I see policy as already in that position where it's supporting both. The policy is restrictive. It's going to continue to bring inflation down, and it's going to do so in a way that doesn't strangle the labor market, break it, and then give people lower inflation, but take their jobs. And that's not what we're trying to do. We're really working towards that soft landing.
Mary, you've used the word "we" a lot when you talk about what's happening at the Federal Reserve. We've had some people who are quite critical of the Federal Reserve and Chairman Powell's performance specifically in this news conference. One excuse that was given was that maybe he was struggling to reflect the lack of a consensus on the committee. How much diversity of thought, disagreement is there on the committee? You call it a close call for yourself. But was there some disagreement on the committee at this meeting?
Well, you know, I'm not going to speak about the entire committee. And when I say we, I stay focused on the things we all agree on, which is price stability and full employment, on our efforts to get there. You know, what I would offer is that we have, in my mind, the healthy level of discussion and disagreement. You know, you don't want an FOMC that thinks exactly alike. And I believe that what people are looking at is the fact that now the world is more uncertain and people are debating and bringing in their views, and that's appropriate. When it was a pandemic and there was only one direction to move interest rates, we had to do it quickly, it was obvious everyone agreed. When inflation's high, there was no disagreement, right? We're all marching up. Now you should expect more disagreement, more differences of opinion, but they're always framed to the same thing. How do we get inflation to 2 and restore or keep full employment?
When I hear the world is more uncertain, a lot of people hear, well, that's not about the data, that's about the incoming administration.
I would disagree.
Why would you disagree?
Because we have a variety of risks that are the ones we always deal with, right? The housing inflation. Right now, there's a substantial housing imbalance in the United States. The models and our data and our past experience all say housing inflation will come down, but we are uncertain about that, right? It hasn't come down as quickly as the models would have predicted, and so that's an issue. The labor market and consumer spending and growth are much faster and stronger than people would have predicted at this point, given the tightening we've done. There's a lot of uncertainty about the natural rate of interest. Where's the stopping point? And then, of course, there's geopolitical risks, the risk to global growth. That's going to be the backdrop, and then you have a change in administration. So I would say this level of uncertainty is normal in the sense that we've had all those things going on, and it's not as excessive uncertainty as after the pandemic, the financial crisis. Those were really big periods of uncertainty. So I think if you're a central banker, you just get used to uncertainty and you manage it.
San Francisco Fed President Mary Daly speaking on Bloomberg Surveillance just a little bit earlier this month. A lot more coming up on the big program this morning. A closer look at the price of chocolate, the price of coffee sitting at record highs. What does it mean for you, and what does it mean for traders? You're watching Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. A quick check on the markets. Trading is thin around the world. A lot of markets in Asia, including South Korea and Japan, are closed, as are several markets in Europe, including over there in London. In Paris and Germany. We talk about here in the U.S. and a slight bid that we're seeing into U.S. futures. The S&P futures up about 0.3%, a potential punctuation mark on a 20+% rally on a year-to-date basis. Euro dollar relatively unchanged, belying the strength that we saw on the dollar this year, a 7% rally versus its main basket of peers. The 10-year yield camped out around 4.5%. Brent crude prices up about 7%, 0.7% on the day to 71.51. And we should point out that big rally we saw in natural gas futures yesterday, about a 13 to 14% rally, pulling back just a little bit today, down about 4%. And that is where we start right now at this hour. A closer look at commodities under surveillance this morning and the outlook in 2025. We talked about gold a little bit earlier. How about cocoa futures? Up more than 170% on a year-to-date basis. Best performance going back to 1960. Record high here, surging on renewed supply fears, and that's driving the most active cocoa contract in New York to make its biggest intraday jump going back to May. We should point out coffee futures also higher as well here, heading for what is going to be yet another record high for those commodities. Kona Haque joining us right now, ED&F man, looking ahead, writing that the outlook for commodities is going to remain, well, sluggish next year due to potentially strong U.S. dollar, unless China stimulus changes that demand. I'm pleased to say that Kona joins us right now to talk a little bit more about that outlook. And I think we have to kind of start, Kona, with actually what drove these phenomenal gains in prices this year. Was that just about the supply-demand dynamics? Was it about geopolitics? Was it about weather? What?
So for the two top performing commodities, coffee and cocoa, yes, it was definitely supply-demand dynamics, and which in turn is all about the weather. So with coffee, we had extreme drought, extreme dry conditions in the two major producing countries, which is Brazil and Vietnam. And in cocoa, we had not necessarily directly weather-related issues, but certainly the supply side where we had, poor yields in Ivory Coast and in Ghana related to disease on, old trees. And yes, a little bit of dry weather. Recently, the Harmattan winds in the West African region have come a bit early. So that's also causing problems to the crops. I think a combination of massive supply problems have definitely hit both cocoa and coffee, which means we've got really tight deficits for numerous seasons in a row now.
And so, Kona, I am curious about this idea of how the market adjusts to this, because you look at the trajectory of prices, how fast they went up here, and we know all the collateral requirements and other things like that. It's caused a lot of issues for a lot of the brokers and the dealers out there. Is that volatility, I mean, irrespective of where prices go, is that volatility that we saw this year going to be repeated in 2025?
Yes, the short answer is yes. And the reason for that is because stocks are very, very tight, whether it's exchange inventories or actual physical stocks, both at origin and also at the destination, the importing countries where most of the consumption is happening. Stocks are ridiculously low on a historical level. So when you don't have that buffer, ultimately what happens is price has to give. So you get extreme volatility because you haven't got that necessary cushion that you need. And what's worse is that these trees of both cocoa and coffee, they're not annual crops like soybeans or wheat, where when you have a good price, the farmers will respond, they'll plant more the next year, and you get a good immediate supply response. Unfortunately, with cocoa and coffee, the supply response is very lagged. So you're going to see, in response to the current high prices, you're going to see a lagged impact, maybe in a couple of years' time or late, earliest a year to 18 months. So you're not going to get that supply comfort coming earlier. And that's on the supply side. On the demand side, you're also not going to see an immediate contraction in demand to address that supply-demand imbalance. And that's because, again, there's very inelastic demand for both coffee and cocoa. People are not ready to give up their cup of coffee. People are not ready to give up their chocolate. It's a small luxury that they're willing to pay. And so that inelastic demand means, again, you have no movement on the supply demand in a hurry, which then leads to volatility, as you were mentioning.
I can certainly relate to not giving up on the cocoa and the coffee. But Kona, talk to us a little bit about it from a trading perspective here. I mean, the last time we saw these moves in various agricultural products, it was almost from a lot of macro tourists, a little bit of a hedge against inflation. Could that, if we do see an uptick next year, still play that role?
Yes, I think that's something that seemed to be growing, from a very small from a small point of way. I think what we can begin to see is the hint of inflation being very sticky and not having disappeared, and if anything, resurging. Now, if that starts to take off in a bigger way, then you could start seeing the world, and particularly the traders, becoming more aware. Okay, so if we have inflation again, what do we do? In that context, commodities could suddenly become an interesting asset class again, because as you know, commodities are a very good asset class as a hedge against inflation. Certainly, we saw that in 2020 2022, just after the Ukraine war, when everything went up, whether it was energy or food, you saw commodities as a complex pickup. Now, could we see a repeat of that? Potentially, but nowhere nearly as extreme, because obviously we're not seeing double-digit inflation. We're going to see more of a sticky inflation, which is definitely lower than 2 years ago, but higher than what the central banks would like. So if that's the case, do you want to put money into commodities? I think people will pick and choose. I think things like gold might be a good option because that's attracting safe haven demand, and there'll be no shortage of uncertainty in the macro environment in 2025. Others will be pick and choose based on their supply-demand balances. So I think, again, some of the soft commodities will do well because of the weather issue. You could start seeing, certainly if China's stimulus starts to pick up, I think certainly some of the metals could do well. Arguably in 2024, some of the metals overran their fundamentals. I think copper rallied more than they needed to, and then it took a hit when they realized that China's economy is not as strong. But if the stimulus starts to become better than expected and longer lasting, then maybe the metals could do better. I'm a little bit concerned about grains. I think grains, look very well supplied. And I think in the environment of tariffs and trade wars with China in particular, you could see the CBOT futures for grains and soybeans remain pretty under pressure.
So Kona, when we talk about this, I mean, I follow your fundamental narratives on if there is an inflation uptick, these are some of the assets that could benefit. Is there a risk, though, of folks that aren't maybe used to this kind of commodity trading or the volatility you mentioned to Romain as well, almost hurting the way some of these prices work and are traded? And I have specifically referenced some of the moves that we saw in 2021 and 2022 because so many people who don't traditionally trade commodities ran to the asset as that hedge. Do you see a risk of that happening in 2025?
I think we will not see a rush to commodities like you saw in 2021. And I think big reason for that is because the dollar is very strong. Commodities and the US dollar have a natural inverse correlation. So the fact that we're going to 2025 with a very strong 2-year high in the US dollar index, and my opinion is that the dollar will remain strong in 2025 because of Donald Trump, president-elect's policies, which are all pretty inflationary, which in turn would be supportive of a stronger dollar. If we do have that environment, then I think it's going to be difficult for commodities to outperform. So I think that will be the biggest headwind for commodities, generally speaking. And so therefore, you will not see a broad-based increase in the commodities asset class as a whole. But as I mentioned before, I think people will selectively choose which markets to go into. Even oil today, it's been pretty stable for 2024 as a whole. Yeah. But if Iran were to see increased sanctions, Russia too, then suddenly oil could be an interesting one due to geopolitics. Yeah. This year it weathered it really well despite numerous tensions around the world, in the Middle East in particular. Oil took it all in its stride, but Iran could be another issue if supply were to be impacted there.
All right, Kona, I have to leave it there. Wonderful stuff. Kona Haque over at ED&F. And man, a closer look here at the commodities space, sitting on losses in the energy space, but some of the metals, particularly in the precious metal space and in some of the soft commodities with regards to cocoa and coffee, having phenomenal years. A lot more coming up here on Bloomberg Surveillance. A conversation up ahead about valuations with Brooke May of Evans May Wealth. And we're going to talk to Jason Baumgarten. I don't know if you've been taking a look at all the CEO departures that we've seen this year, but Jason going to have some perspective here on whether we see a repeat of that in 2025. Pavel Molchanov having a conversation up ahead on renewable energies. And if you bought luxury real estate in Florida, you probably bought it from one of our next guests. All that and more coming up next, right here on Bloomberg Surveillance.
Market is seeing that the economy is not weak.
We're getting to a point where equity risk premiums are incredibly narrow.
I don't know what to expect, but I'm not really sure if markets really know what to expect. I think that creates some volatility.
There's quite a lot of momentum still to be had, particularly in the first half of next year.
As goes January, so goes the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
7 a.m. in New York, 1 p.m. in Paris, midnight in the Fiji Islands. Happy New Year to our audiences worldwide. This is Bloomberg Surveillance. Romain Bostic in our world headquarters in New York. Kriti Gupta over in London. Kriti, as we take a look here at financial markets, closing out what has been a phenomenal year. The S&P headed for its 5th straight quarterly gain, and that's going to cap a 24% rally on the year. You put that together with the rally we had last year, Kriti, the best back-to-back years right now, at least for U.S. markets, going back to 97, 98.
It's a pretty decent stat. I think what's fascinating is in just the last couple of hours, it feels like the sentiment around the markets have completely changed. Romaine, when I came in for our morning shows here in London, the markets were down, and they were down hard. You've seen the sentiment just completely evolve in the future story now, deep in the red, now certainly into the green. And
it's kind of interesting, too. We talk about kind of what sort of led this rally. We talk about the start of the year, certainly here in the U.S. It was all about those big tech companies. Some of that was a play on technology, but a lot of it, as you know, Kriti, was a play really on fundamentals, on cash, on profitability. But then we saw that rally broaden out here in the U.S., and then now it's kind of narrowing once again here, Kriti, towards the end of the year.
I think what was so surprising of this year is that even though I think we were expecting so much of that concentration risk that you mentioned, that the real shock to me was how the market sold off around the Fed story. The fact that so many Fed cuts were actually priced in when I, like you, attributed it to, say, the Trump trade or the broadening or even the economic resilience you saw in the data. But there were still so much of that monetary policy baked into a market that maybe didn't need it.
And monetary policy was a big part of the story this year. Could potentially be next year. Even if the Fed doesn't do anything, that in and of itself could be a big story, too. A lot coming up this hour. A conversation up ahead in just a second with Brooke May over at Evans May Wealth on why she says the market might actually be overdue for a correction. And we're going to talk with Jason Baumgarten over at Spencer Stuart on the record number of U.S. chief executives who left the corner office this year. Pavel Molchanov over at Raymond James going to be joining us to talk about his outlook for oil and renewable energy as well. But let's begin this hour with a closer look at stocks which are on track for their second straight year of 20% plus gains. However, 10 stocks, just 10 stocks accounting for more than 59% of that advance, going back to the S&P bottom back on October of 2022. New York University finance professor Aswath Damodaran spoke to Bloomberg a little bit earlier here about the narrow breadth that we've seen in this market.
I've never seen a group of companies carry a market for as long a period as the Mag 7. The Mag 7 companies alone, if they were a market, would be the second largest equity market in the world after the US equity market. These companies, at least most of them, are cash machines. I've never seen cash machines as lucrative as these companies are. And I don't see the cash machines slowing down.
And we go from one of the brightest minds in finance to one of the other bright minds in finance, and that is Brooke May over at Evans May Wealth. And Brooke, I do want to start off with what Professor Damodaran was talking about. Kind of two sides of the coin here. On one hand, you don't want to see this tight concentration in the market. On the other hand, we're talking about a tight concentration of companies that are just kind of just pumping out cash at levels that we've never really seen. I can't really think of any real parallel other than going back to the robber baron era at the turn of the last century.
Absolutely. When you look, though, at, stretched valuations, which there's been a lot of criticism of in the S&P 500, a lot of those higher PEs are attributed to those top 10 stocks. And when we look at their earnings growth rates, they're strong. So that's what you want. You want companies that are growing their earnings that can justify those higher PE ratios. When we looked at the big tech going into 2024, earnings were expected to be up 28%, whereas the other 493 names were only expected to have earnings growth around 7%. Going into 2025, the narrative has changed. Big tech earnings are expected to be up about 21%. But the other 493 names, earnings are expected to be up 13%. So we are seeing a broadening in participation. And we think that, if you peel out those top 10 names, the PE ratio that you have on the market is much more reasonable and in line with the 5- and 10-year averages.
Well, that seems to suggest that we could see a meaningful extension of this rally. And that doesn't necessarily mean we won't see pullbacks or even a correction in between. I am curious as to what you think the biggest risk for this market will be next year.
Environment that's good to be an investor. We've got low unemployment. We've got deregulation on the horizon. We've got an economy that's growing. And so our base case is that the market will do well based on the broad economy. However, there are quite a few factors that we're looking at. Some of them are policy related. And, I think that that's another reason why the Fed's going to be cautious. We want to wait and see. President Trump has been very vocal about what policy initiatives he wants to take. And there's some concerns around what tariffs might mean for the economy or what deportations could mean for the economy. So we're ready to pivot if it looks like there are factors at play that might be somewhat of a speed bump for the market.
Brooke, if I can ask you a more sector-specific question, especially around the policy story. I mean, I feel like a key part of the Biden administration, the Biden trade, if you will, was the CHIPS Act and this massive move you saw in the CHIPS sector, not that just wasn't just driven by the AI story or the tech story, for example, but actively was because the federal government was granting funding to so many of these companies, Intel, Micron, et cetera. You saw that in the Trump trade as well, almost Biden unwind from that sector. Is that the right approach when it comes to how you stock pick here, what sectors the federal government funds at the end of the day?
Not necessarily, because that can change. And we're looking for companies that have long-term sustainable earnings growth. The ones that we like right now, NVIDIA, Broadcom, Taiwan Semiconductor, and the hardware space, we think can continue to do well regardless of subsidies. That said, we are shifting this year our focus more towards companies who've also embraced AI, but are doing it from a software standpoint. And they've been able to show their customers and their clients that they can be accretive to their earnings and help grow their business with additional services and products. So we're looking at companies also like ServiceNow and Salesforce that are using more of the software side in addition to the hardware.
So, Brooke, some of the companies that you just named, they have one other thing in common, is that they're all sitting on a lot of cash on their balance sheet. A lot of the tech companies are as well. As a more long-term investor, how are you thinking about cash on balance sheets? Is that something to be deployed, or is that something to use as a cushion for policy uncertainty?
When we look right now at CEOs and what they're telling us, the sentiment is okay. It's not overly optimistic, but it's okay. And when they tell us where they're going to spend, it's in CapEx, R&D. We expect CapEx and R&D spending to be up about 8 to 9% over the next year. But we also see M&A activity and share buybacks and increases in dividends to be really even more of a commitment when it comes to their spending. We think M&A spending could be up 20%. Dividend increases could be up 7%. So there's a lot that they can do with that cash that we think will be beneficial to investors, and they're planning on deploying it.
And just to kind of wrap this up, Brooke, I am curious, too, because we talk about the challenges for 2025, and it obviously goes beyond fundamentals. You mentioned the policy issues here in the U.S. and obviously geopolitical issues that, frankly, still have not been resolved. Do you think there's enough hedging in the market right now? This has been a big topic, not just amongst traders themselves, but even amongst long-term investors. Are people protecting their portfolios against those potential exogenous shocks?
I don't think they are. I've been in the market for 25 years, and I've seen the tech bubble burst. I've seen the Great Recession, and this is an environment where investors have made money for several years, and you let your guard down. We don't see, though, right now an overextension of margin and leverage. Which, typically to see a bubble burst or a big correction, you're in an environment where you don't have cash and you've got a lot of margin. So we're not necessarily overextended, but I don't know that investors are necessarily taking a cautious approach right now.
All right, Brooke, going to leave it there. Brooke May over at Evans May Wealth. We thank her for her time and Critty. It was kind of interesting. We talk about this 24% rally in the S&P 500 this year. $1.5 trillion in market value added to the S&P 500. Yet there were just about 8 people who accounted for 43% of that. And you can guess who they are. It's the Elon Musk and Mark Zuckerberg and Jensen Huangs of the world. Their wealth collectively, those 8 folks, going up by $600 billion this year alone.
You know what's surprising me, Raymond, is that their wealth affects everyone's wealth via the stock market, right? If you're talking about this bromance between Elon Musk and Donald Trump, this brings me to back when Elon Musk bought Twitter, and it actively affected Tesla shares. It actively affected the S&P 500. If that bromance dissipates, does the stock market drop too?
Yeah, I mean, that's a big part of the question here. And of course, we talk about these sort of singular individuals and how so much of their fortunes, at least going forward in 2025, are going to be tied certainly, to some of those policies coming out of the White House and favoritism, if you will. All right, let's get you an update on some of the other stories going on out there this morning. Haque is standing by right now with our Bloomberg Brief.
Hi, Romaine. Cities around the world are preparing to ring in the new year with celebrations highlighting local cultures and traditions. In Auckland, New Zealand, they've already welcomed 2025 with a light display recognizing the city's indigenous tribes. At 8 a.m. Easter, Sydney, Australia will ring in the new year. Meanwhile, South Korean authorities are investigating airport infrastructure at the site of the Jeju airplane crash. This as questions grow over how a concrete wall at the end of the runway may have contributed to the disaster. International safety experts questioned if the crash was made worse due to the position of the structure and being made partly of concrete. And online ticketing platform Vivid Seats might be exploring a sale after receiving takeover interest from private equity firms. That's according to sources. Vivid Seats shares jumped yesterday on the news, but are still down more than 26% this year, as you can see. Sources say the company's deliberations are ongoing and there's no certainty it will lead to a transaction. Vivid Seats said it, quote, doesn't comment on rumors or speculation. That's your Bloomberg Brief. Romaine?
All right, our thanks there to Haque there for that Bloomberg Brief. And Kriti, I'm not sure if you actually plan to go out on this New Year's Eve over there in London, but there was an interesting poll here in the U.S. showing that the majority of people, they just stay home.
I mean, I think that's what I'm going to do. Me, my dog, watching the fireworks on TV. That sounds like a dream, Romaine.
Yeah, I mean, I guess I'm one of those people, too. I mean, we are going out, but I should point out we're not going out tonight. We're actually going out in the afternoon, and we'll be home well before the fireworks and all of the festivities start. But it gets to this idea here of just how much of this holiday, if you will, is actually a revenue generator. I know there are a lot of folks, certainly in New York, who want to go out and brave the elements to see the ball drop or go out to a nightclub or restaurant, if you will, here. But there's so many people that just decide, you know what, it's just not worth it.
Yeah, absolutely. I don't know about you, but here I'm learning a lot about some weird kind of traditions that Europe has. I learned today, for example, that in Germany, they take little lead or wax figures, for example, throw them in water, see what form they make, and that's a fortune teller of what their new year is going to be like. And I've got about 20 more of similar examples.
Oh, yeah, there's a lot over there. And, of course, back here in the U.S., we have our own traditions as well. And, of course, as we bring in the new year around the globe, actually closing in just a little bit's time here, we're going to start to see Russia actually move on to the midnight hour here. Vladimir Putin already out with the statement in his New Year's address, marking his 25 years in power and what he is calling his, quote, proud achievements. Of course, Vladimir Putin going to be a key figure in the news heading into 2025, given the war in Ukraine and his relationship with the incoming president of the United States of America, Donald Trump. When we come back here on Bloomberg Surveillance, we're going to take a closer look at what's going on in the C-suite. We're going to dive into the reported uptick in CEO departures, record levels this year. Jason Baumgarten of the leadership advisory firm Spencer Stuart is going to be joining us to talk about what's behind the trend and, more importantly, whether it continues. You're watching Bloomberg Surveillance. U.S. futures pointing to a slightly higher open. The S&P 500 futures right now up about 0.4%, a punctuation mark on what has been a 20% plus rally on a year-to-date basis. Similar percentage gains for the NASDAQ on a year-to-date basis for the Dow and the Russell. You're sitting on gains on a year of roughly around 10% or so. Most markets now have started to shut down. Quite a few in Asia are already closed for the New Year's Eve holiday, some in Europe as well, as we approach the midnight hours across the world. Euro dollar unchanged on the day. Your 10-year yield here in the U.S. camped out right around 5.5%, unchanged on the day as well. And an uptick here fractionally for WTI crude in New York, 0.9% to 71.60 a barrel, despite the fact that on a year-to-date basis is going to end the year, it appears, roughly unchanged. Of course, oil, energy, and commodities, those were some of the big stories of the year. But another big story this year, and it is under surveillance, and that is the number of CEO departures. Here's the latest on that. Record numbers of chief executives at public U.S. companies are reportedly leaving their posts amid increasing scrutiny. Jason Baumgarten of leadership advisory firm Spencer Stuart saying it's hard to draw meaningful conclusions about why these CEOs are leaving their jobs from broad statistics alone. But at Spencer Stuart, they believe you need to understand the 3 C's: the CEO themselves, the company they were leading, and the context in which they were operating. Pleased to say Jason Baumgarten joins us right now, and I want to start with that 3rd C, and that is the context. Has the job just gotten too hard?
Well, as you know, there's a lot that can be going on in a company and with a CEO's tenure. You can be facing enormous uncertainty from global tariffs, a huge boom from AI. And so depending on what situation a company finds itself in, what is going on in the industry, and then how is the company responding, it's certainly something that matters. And context is both about the industry, but it's also about how that company has historically responded. Does the CEO have a plan, and how's that plan actually seeing the results that they and the board of directors and ultimately the shareholders want to see?
I am curious about these statistics. I don't think we have a breakdown exactly of how many of these departures were willful and how many of these were folks forced out. But when you look at the trends yourselves, I mean, what do you get a sense of? Is this basically the board saying, okay, we need a leadership change, or is this the individual CEO basically just saying, you know, I'd rather do something else with my time and my life?
It's a great question. And the reality is it's all of those things and more. In some cases, CEOs are just saying, hey, this is a tough job. There's a lot more media scrutiny. There's a lot more always on attention. There's a lot more stakeholders to make happy. And it's harder and harder to eke out performance. As your segment before showed, so much of the performance is driven by so few companies. And so it's harder and harder for CEOs to see the value creation under all of this, and to have an increasing amount of pressure on them as individuals. So some are just saying, hey, I've done well. It's time to let the next person lead. The context is changing. Let's have a changing of the guards. In other cases, the boards are sitting there saying, we want a different rate of performance, or we want a different change in direction, whether they're doing that or they're doing that under the scrutiny of other stakeholders. We do see boards taking action faster. Our own studies and research on the topic, the faster boards take action, the more likely the company is to perform well after a decrease in performance. So it's sensible for a board to take action. On the other side, some CEOs are just saying, hey, it's time. I had a good run. I delivered a lot of value, and time for the next generation. I had a CEO recently tell me they retired at 60. They were thrilled. They were taking their first real vacation, as they put it, in 45 years. And they said they were getting their knee replaced, going for a hike, and hanging out with the family for the first time really in their professional career, because they had just been fully on 24/7 for 40 plus years.
Wow, that is quite the run for that person. Jason, I'm curious about the approach that CEOs use here. I'm curious about if the limelight is something that helps or hurts their case. I mean, I'm thinking of, say, Jamie Dimon, a Tim Cook, or a Mark Zuckerberg, who maybe could benefit from the spotlight, but then maybe bring about more scrutiny as well. How do you think about that?
Well, we often focus on a few individuals, and the reality is there's 1,500 CEOs in S&P 1,500, and there's 500 in the S&P 500. So a lot of executives, a lot of leaders who are trying to do this in their own companies to drive value, to drive employee satisfaction, to drive satisfaction in their communities. All of those CEOs are under scrutiny in their own ways and shapes. So they all have to think about how to yield that public persona carefully, and to really make as many people happy while still delivering on the fundamental values that they're trying to deliver on for stakeholders and for shareholders.
Well, Jason, we're on a financial network at the end of the day, so I've got to ask you a question about buybacks. I mean, this is something that has been such a point of contention for so many people when it comes to, do CEOs just want to see their stock rise at the end of the day in terms of compensation, or in terms of buybacks, or in terms of shareholders, or whatever? How do you think about that?
I think increasingly boards have to think about, are they seeing the value creation they want from the CEO, and is it following the plan that the CEO put forward and that the management team is executing on? If they're seeing the results, sometimes those are interim steps, interim things, whether it's revenue increase, margin increase. Those then have to translate in the market. But as you know, those don't always translate right away or in obvious ways. So the board has to be that go-between to say that they're seeing the results they need from the CEO and the management team on behalf of shareholders that will ultimately lead to shareholder increases. If part of that plan is to buy back shares, then that's something they're going to evaluate. If they see that as a part of the plan that they're not as happy about, then they're ultimately going to value that as part of the CEO and the management team's evaluation at the end of the year.
Jason, I am curious, though, also. I mean, we talk about some of these CEO departures in the context of those folks who maybe just, like I said, just kind of done with the job. There's kind of the opposite effect, too. You have some transition issues of certain CEOs that, let's just say, are long in the tooth, have been in the job for quite some time. Not to say they're not doing well, but there are a lot of questions as to what's the transition. You know, whether you're talking about a JP Morgan, whether you're talking about a Disney, for example, as well. I am curious as to how proactive these boards are in making sure that for some of their CEOs that have been in place for a long time, that are getting to an age where you have to start thinking about who's going to come in next, how much influence they really have to make sure that there is an orderly and smooth transition.
Well, listen, we do a survey every quarter called the Measure of Leadership. We ask 2,000 CEOs and board members what's going on in their roles and in their companies and in the general context. Two things that stood out to us in this last survey that we did. One, CEOs and boards were unanimous at the amount of uncertainty in the economy. Roughly 80% in both groups said it's more uncertain. The second thing is that in light of that, only about 50% of boards reported that they had robust succession plans in place. And many of them, when pressed on the topic, said that they wouldn't have multiple options, which is what we really look for, is does a board have multiple options? The final thing that we're seeing is a real trend away from it has to be an internal candidate as a badge of success. The reality is boards should look internally and externally at their candidate pools and really make sure they're doing all of that diligence before the time comes. And finally, it takes real work, and it's uncomfortable work for boards to ask these questions of CEOs, many of whom have been in the seat for, the average is 8+ years. Even though that's down a little bit, the reality is if you've been on a board for 8+ years with the CEO, you've got to sometimes say, hey, does the strategy need to change in addition to the CEO as again, that context might change for the CEO that the prior CEO didn't have to wrestle with.
And just real quickly here, are those skills still transferable? I know in the past we used to always talk about this idea that being a CEO was just all about management. If you managed a food company, you can manage an industrial company or a financial company. It was just management. Is that still the case?
I think we are always seeing industry shifts, CEOs coming from one industry going to another one. The reality is that it's a slightly scarier thing for a board to do, but it can work. And CEOs who are great people leaders, who are great at thinking about how to create value, great at asking the right questions, great at recruiting talent, can usually drive value as long as they're willing to put the extra cycles in to learn what they don't know and bring that beginner's mind to learn about the industry if they are shifting industries.
All right, Jason, going to leave it there. Jason Baumgarten over at Spencer Stuart, the leadership advisory firm. A closer look at the record number of CEO departures that we've seen this year, at least based on the tally that we've seen coming out of Challenger Gray. When we come back, one of the hottest sectors to start the year, that was energy. To end the year, well, it's one of the worst performers. A conversation coming up with Pavel Molchanov over at Raymond James. His outlook for the energy sector, where oil prices are headed, and where is exactly that renewable energy trade. The sun coming up over New York. This is Bloomberg Surveillance. S&P futures right now pointing to a higher open, looking to snap a 3-day losing streak here on this final trading day of the year. S&P futures higher by roughly about 0.4% here on this day, well off the record high set back on December 6th, but still punctuating a year that is now a gain of roughly about 24%. NASDAQ and Russell futures also moving higher here on this morning. In fact, equity futures across the board are in the green right now. Yields across the board are lower. We should point out the volumes today are light here on this New Year's Eve, but we did find a couple of stocks worth watching here on this day, with just about 2 hours away from the cash open of equities. Let's get to our morning movers right now with Yahira Haque. Yahira.
Hi, Romaine. We start with Sangamo Therapeutics. Those shares are down more than 50% in the pre-market after Pfizer decided to end its partnership with the company for a treatment meant to treat hemophilia A. Pfizer is saying that there's just not enough interest for another gene therapy option for the disorder. As for why, the shares are plummeting. That's because analysts are warning that this could worsen Sangamo's liquidity issues. Next up, we have MicroStrategy. Those shares are rising 4.7% in the pre-market, and that's after the company, which has been stockpiling Bitcoin, said it's buying more, $209 million worth. And that is less than the amount that it bought a week ago. As for why the shares are rising, well, it was part of the tech sell-off yesterday, so it looks to be making up some of that. Also, you are seeing Bitcoin prices rising today, and we know that where Bitcoin goes, MicroStrategy follows. And last up, we have Tesla. Those shares are up some 1%. They also sold off yesterday, but look to be on the mend today, even though we do have a report out that Tesla is recalling more than 77,000 vehicles in China due to software issues and even potentially faulty airbags. But something to watch out for this week is the company is set to report fourth quarter and full year deliveries, and that is set to come on Thursday. Romain?
Absolutely a phenomenal year, though, for Tesla. 68% gain in that stock on a year-to-date basis, and MicroStrategy, just a phenomenal year, up almost 400%. In fact, one of the best performing stocks among the 1,000 biggest companies out there in the U.S. We do want to turn our attention right now to the commodity space and specifically energy. Oil markets, well, they're pushing higher here in the last trading session of the year. This after we got a report that factory activity in China did expand for a third straight month. Pavel Molchanov over at Raymond James, he's looking ahead to next year. He says that, well, they're forecasting oil prices to be largely range-bound. However, the main energy story of 2025, which was also the main story of 2024, is set to be electricity rather than oil. Pavel joins us right now to talk a little bit more about that. And Pavel, let's talk about it here. I mean, if you had told me coming into this year that some of the biggest gains in the equity market would be utility and power companies, I would have said you're crazy. But here we are at the end of 2024. Talking about utilities and power companies. That continues to be the story next year?
Yeah, I mean, this is the derivative trade on AI. So the euphoria around AI touches what we might call the picks and shovels of the electric power industry. So the utility stocks, the equipment providers, so everything from, gas turbines, wind turbines, solar panels, battery systems, and also the construction companies that are, physically building all of this energy infrastructure to accommodate the boom in electric power consumption.
When we talk about the building of this infrastructure, and you have obviously new infrastructure coming on here in the U.S., you have old infrastructure, old nuclear plants coming back online here. Is there enough out there, I guess, if you will, for these companies to draw on, or are we going to be facing significant shortages in power given some of the demand needs out there that we know of, at least when it comes to computing and AI?
Well, our listeners do not need to worry about, physically running out of electricity, at any point in the foreseeable future. That's not going to happen. What is true is that power prices are already trending up. In fact, they've been up since pre-COVID by about 25%, and we should expect power prices to continue moving higher. In part because of the additional demand from the data center build out. And look, let's also keep in mind the geographic differences here. The bulk of the data center, or the largest portion of the data center build out, is happening around Washington, D.C., Northern Virginia, Maryland, a little bit into Ohio. There's not as much happening in the western half of the U.S. There's also, by the way, data center build out, AI related in Europe, in parts of China. So this is a global story. But Northern Virginia has the largest portion. So naturally, that's where the infrastructure needs to move forward at the fastest pace.
Pavel, when I first learned about how utility grids worked, I was pretty surprised to learn that you can use both oil and natural gas, and sometimes natural gas can be cheaper in utility grids as well. There's a big conversation in the U.S. right now about exporting a lot of extra natural gas and LNG to Europe. But if you see this AI data center build out in the U.S., do those flows get redirected?
Natural gas going to Europe will be limited not so much by the ability of American gas producers to pump as much as they want, but rather by Europe's need to import LNG. And here's why I say that. Since Russia invaded Ukraine 3 years ago, Europe's consumption of natural gas is down by 15%. I'm not talking about down 15% from Russia. I mean, that's practically at zero. But overall, Europe is using 15% less natural gas. So guess what? That means less need for natural gas from any source, U.S., Qatar, Norway, and Azerbaijan, and so forth. So that's really where the constraint is going to come from.
So there's no necessarily relationship between the natural gas needs of Europe or the natural gas needs of other folks in the United States versus, say, the AI build-out?
We have plenty of natural gas in North America to do both. So natural gas will certainly play a role, particularly in the eastern half of the U.S., to support the data center boom. Now, in the western half of the country, as I said, AI is less of a factor. But keep in mind, we also need to replace coal plants that are being retired. And this is why we're going to be following an all-of-the-above strategy for the electricity mix. Natural gas, wind, solar, and in certain cases, and with also long lead times, nuclear as well.
I am curious, though, Pavel, do you think that, at least here in the U.S., that government policies coming out of this new administration will be supportive of some of those renewable energy initiatives like wind, solar, nuclear, et cetera?
Number one thing we need to understand about government policy as it relates to electric power is that it is predominantly at the state level rather than the federal level. Electric utilities are regulated by state-level utility commissions. There is a little bit of a role played by FERC and the Department of Energy in Washington, but number one is the state-level regulation. So here's an interesting fact for some of your listeners. 29 states have a renewable portfolio mandate for electric utilities, including, by the way, some red states like Texas, Missouri, and Montana.
Yeah, and it'll be interesting to see whether that holds and how that interplay between those states and the federal government goes forward. I do want to ask you a much more straightforward question about the oil market and particularly about the mobility of oil. Obviously, there are a lot of concerns about geopolitical issues and the disruption of flows of oil. You have the wars obviously going on in the Middle East and elsewhere that have also disrupted the flow of oil. Do you see any sort of right sizing in that next year, or are these sort of, I guess, issues that are going to just remain lingering for a good portion of the year?
For the past 12 months, we have had two major wars, Russia-Ukraine, and of course, what's happening in the Middle East. Despite that, oil prices have barely moved since January 2024. Why? Because we also have to take into account what's going on with demand, and demand has been weaker than expected, in large part because of China. So number one question for next year is not so much geopolitics, it's good old-fashioned supply and demand. What's going on in China with the economy? And by the way, with electric vehicle sales, half of China's auto sales are now electric. That's a big deal. We're also watching the dollar, strengthening dollar, as we have seen pressures commodity prices across the board, including oil. And the third thing we're watching is OPEC. OPEC has been very disciplined since COVID with supply, at some point in 2025, OPEC will begin to unwind its production cuts, which means more barrels on the market, and that may put some pressure on the price of oil as well.
All right. Pavel, great stuff. Pavel Molchanov over at Raymond James. A closer look here at the energy market, the outlook for 2025. We continue our coverage here on Bloomberg Surveillance to look at some of the big stories of the day going on out there. Let's get your Bloomberg brief. Haque is joining us right now.
Hi, Romaine. Mortgage finance giants Fannie Mae and Freddie Mac saw their shares jump over 30% by yesterday's close, sparked by a post from Bill Ackman that stoked optimism that the companies will be released from conservatorship under Donald Trump's administration. Meanwhile, the U.S. government fund created to compensate victims of Bernard Madoff announced its 10th and final distribution this week. The government paid out $4.3 billion to nearly 41,000 people, schools, charities, and pension plans who were swindled by the Ponzi schemer. Victims recouped an average of 93.7% of their proven losses. And Hollywood studios are seeing an end-of-year surge at the box office, with projected ticket sales for the year inching closer to 2023's total. Through Sunday, domestic box office sales were at $8.66 billion, according to ComScore. The three-day weekend total of $165 million was led by Disney's Mufasa, Paramount's Sonic the Hedgehog 3, and Nosferatu from Focus Features. Domestic ticket sales are still below 2018's record-breaking $11.9 billion. That's the year Avengers: Infinity War and Black Panther came out. Feels like a lifetime ago. That's your Bloomberg Brief. Romaine?
Yeah, absolutely. I haven't seen any of those movies, by the way. I got to get out a little bit more. Meanwhile, here on Bloomberg Surveillance, coming up next, the high cost of owning a home.
As we're looking into 2025, what we're expecting is that mortgage rates are probably going to be volatile, similar to what we've seen, but that they're probably also going to remain pretty high.
And of course, there are a lot of people out there who are, well, I guess, concerned about the cost of buying a home. And there are folks out there who, well, don't have any concerns at all. A conversation up ahead on the luxury real estate market. In fact, if you've bought luxury properties down in Florida anytime soon, you probably did it from one of our next guests. That's coming up next here on Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. Quick check here on the markets. Futures pointing to a slightly higher open, but we should point out here, volume is going to be incredibly light, as it typically is here on the final trading days of the year. S&P futures up by about 0.3% here, a potential cap to a 24% run on a year-to-date basis. Not much action right now going on in the FX space. Euro dollar unchanged at the moment here. And we're keeping an eye on yields. 4.5% is where we're probably looking to close out the year. Not where most people expected. In fact, we came into this year with expectations to be a lot lower than 4.5%. And by the time we got to mid-year, the expectations were for us to be, well, a lot higher than 4.5%. You split the difference, a narrow trading range. That's what you get here for the Treasury market. A narrow trading range as well continues in the energy space. Oil futures here in New York, WTI crude 71 and change, up about 0.3% on the day, unchanged on a year-to-date basis. Of course, energy has been a big story of the year. So too has been real estate and the potential rebound that we've seen in a lot of those markets, particularly in the high-end market. And that is under surveillance this morning, the high cost of owning a home.
Mortgage rates for really the last couple of years has, bounced around a lot, but they've generally stayed pretty high. And we're ending the year with pretty high mortgage rates. As we're looking into 2025, what we're expecting is that mortgage rates are probably going to be volatile, similar to what we've seen, but that they're probably also going to remain pretty high. We don't really see a lot of room for rates to fall.
And despite those high mortgage rates, luxury real estate is booming. According to global luxury real estate brokerage The Agency, those home sales rose just over 5% in the first half of 2024, while overall home sales dropped about 13%. Dina Goldentayer is joining us right now. She's a real estate agent over at Douglas Elliman Real Estate, and honestly, one of the biggest brokers down in the Miami, South Florida area, responsible for billions of dollars worth of sales. Dina, I would assume your clients probably aren't too concerned about mortgage rates. They're going to buy whenever they want to buy. But I am curious about their sentiment right now. Are they feeling better about venturing into these purchases, at least better than maybe what they would have been a year or two ago?
2 years ago, they would have felt exceptionally good. 2022 has proven to be the peak of the post-COVID market in my neck of the woods, which is Miami and Miami Beach. But they still feel good about making a purchase that helps them establish roots in this exceptional city.
I am curious, when we talk about this exceptional city, we'd be remiss in not pointing out the huge migration of folks from places like New York, as well as other parts of the country, down to Miami. Some of that was because of the pandemic. Some of that actually started prior to the pandemic. Of course, we kind of call it Wall Street South now. A lot of demand for housing. Dina, is the supply there?
The supply is definitely there, which makes it a better time to be a buyer. During COVID, if you flew in, I would have maybe 3 homes to show you, and you'd be making a full price offer on one of them. Now I might have 10 homes to show you. You have more bargaining power. So buyers actually feel better out there because they can have more selection and they don't have to give in to every whim of a seller. For example, there used to be this commonplace term that I would have to add into my contracts that would allow a seller to stay back, have your money, use it to buy something else, and very rarely pay you rent. Now, as we approach 2025, buyers don't have to offer those types of terms to sellers. Things just can be more normal.
Well, Dina, talk to us a little bit about maybe that dynamic Romain was talking about. I know, again, mortgage rates, maybe there's a little bit of kind of elasticity there with your clientele. But in terms of leverage, are you seeing changes in leverage that people are willing to take out or use to finance some of those buyings?
So in the $440 million in sales that I did this year, 0 had financing.
Oh, well, that says something, certainly. Talk to us about the kind of clientele, though. I mean, again, Romain was talking about from New York to Miami. What about international buyers? Are they driving up some of those property prices?
The biggest international buyer that I'm seeing in my marketplace are the Canadians. And we tend to loop them in as one of us, but they are, in fact, the biggest international buyer for my book of business.
I love the Canadians, Dina, but they're not one of us.
They're nice.
Yeah, they're very nice. I am curious, though, too. Yeah, and just going back to Miami for a second, I mean, I've been to Miami many times. I've been in all the neighborhoods except for one. I've never set foot over there in Indian Creek for obvious reasons. One of the most exclusive real estate enclaves in the country, if not the world here. What's going on over there? I heard Jeff Bezos, right? He's building like, what, another mansion? And then isn't there a property next to him that apparently somebody's snatching up for a couple $100 million? What's going on out there?
I mean, Indian Creek is the sexiest destination in the country. I've had the pleasure of selling several homes there. You know, Jeff Bezos obviously has put it on the map, but Tom Brady was there before, and he's always posting on his Instagram from his beautiful backyard. Oh, I sold that one. So it's really spectacular, and it's like nothing else. And it is billionaire's bunker, but it's also gotten younger. The buyer for Indian Creek is no longer necessarily someone who is in their 70s or 80s. You know, you've got plenty of owners in their 40s on the island, and it's an incredible place. And I'd love to take you there if you're ever in town.
All right. Well, I may actually take you up on that at some point, Dina. But before we get there, I'm curious. I mean, it's interesting you talk about the younger buyers, too. I am curious as to whether the younger buyers, and we're talking wealthier buyers here, whether they gravitate to the same neighborhoods that kind of the older money did. I mean, you kind of saw a big transition in New York where, you know, the Upper East Side was, you know, basically the bee's knees for everybody. And then you had this sort of new cohort of tech entrepreneurs and other people that said, I'd rather be downtown in Tribeca or somewhere a little hipper here. Do you see the same trend in Miami, or are they gravitating to those old money enclaves as well?
That's an excellent question. I've never heard of that juxtaposition, but we definitely have that in our marketplace. You've got kind of the people who would choose the Upper East Side in New York. They tend to gravitate to Surfside, Bal Harbor. You've got people who would choose Tribeca or Soho. They gravitate more towards the South Beach and South of Fifth area. And then the tech money, they love the Venetian Islands. But to also answer your question, yes, new money loves the same thing as old money. They love Fisher Island. They love Indian Creek. They love being there in their 40s. When it used to be only for people in their 70s or 80s. Luckily, we have enough of a buyer pool to support all these incredible neighborhoods.
All right, Dina, great stuff. And obviously you have some great insights into what's going on down there. $3 billion in sales just since 2021 alone, $450 million. It's hard to believe just this year. Congratulations on your success. We'll catch up with you next year in 2025. Dina Goldentayer over at Douglas Elliman Real Estate here, Creedy. And I was also taking a look. One of the biggest sales that we had this year down there was actually the Beckhams. $72 million property they purchased over there on North Bay Road. And you know what I love about them? Aren't they British?
Tell me.
Aren't they one of you now? Yeah.
Oh, am I British now? Can you tell from the accent?
Yeah.
Look, I don't know if the British would want me, but I think it's important to keep in mind that that's not just the Beckhams, it's Lionel Messi as well. He now lives there. He's driven some of the property prices up. I hear he's potentially making some of his assets into a REIT as well. So I don't know, something's going on with Miami, but then I hear so many people are leaving for Austin, Texas, or San Francisco, or Seattle. So I don't know, Romaine, what's the new Miami?
I don't know. I mean, that's a big, I wish I knew. I mean, I wish I had gotten in on the new Miami when it was the old Miami, or the new Austin when it was the old Austin, or whatever, but it'll pop up somewhere. I was also curious too, I mean, just kind of speaking of kind of the wealthy and the celebrities, did you know that Brad Pitt and Angelina Jolie got divorced? Which was surprising to me because I thought they got divorced like 10 years ago. But apparently this has been like an 8-year-long divorce process that apparently has now just been finalized and basically going down as one of the longest and most contentious divorces, at least according to the Associated Press.
We're finally talking about the stuff I want to talk about, the real news you can use, I think, Romaine, which is basically, and I think I know way too much about this custody battle or this kind of divorce than I should, because I believe a winery was a big part of the conversation, a winery that they had a joint ownership of, and I admit I have not read into the latest of who got the winery, but I hear it was a very contentious piece of property.
Yeah, I mean, anytime you have these types of celebrities and that type of wealth and the type of assets, it's always a bit complicated to kind of sort it all out. But 8 years? Oh, my gosh. All right, Creedy, we got a lot more to talk about here on the big program. And actually, I just want to say, I mean, Creedy's actually going to be leaving us. So I just want to say, Happy New Year to you, Creedy. Thanks for being here on Bloomberg Surveillance this morning. The final hour will be taken over by Sonali Basak, but we'll talk plenty next year. Our thanks there to Creedy Gupta as we say goodbye to her. Stick with us here on Bloomberg Surveillance. A lot of big guests up ahead, including Matt Miskin over at John Hancock, Tom Fitzgerald at TD Cowen, and Danielle DiMartino Booth. Talk about here the future of the Fed. And how about this? A ball drop here in New York City, and of course a focus on security, a conversation with former NYPD Commissioner Ray Kelly. You're watching Bloomberg Surveillance.
Market is seeing that the economy is not weak.
We're getting to a point where equity risk premiums are incredibly narrow.
I don't know what to expect, but I'm not really sure if markets really know what to expect. I think that creates some volatility.
There's quite a lot of momentum still to be had, particularly in the first half of next year.
As goes January, so goes the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
8 a.m. in New York, 3 p.m. in Jerusalem, midnight in Sydney, Australia. Happy New Year to our audiences worldwide. Good morning. This is Bloomberg Surveillance. Romaine Bostick here in Bloomberg World Headquarters in New York, joined for this hour by Sonali Basak. Happy New Year, Sonali.
Happy New Year to you.
People already celebrating around the globe. You got big plans for tonight?
No big plans, but my parents are in India, so they'll be celebrating soon as well. So exciting to see it happen all across the globe. I do feel sentimental.
Yeah, I mean, I always like this. I never really stay up to midnight because I'm one of these early birds. I go to bed early, but we are going out this afternoon. My whole family's here, and we're gonna have a little bit of fun, and then hopefully I can get to bed before.
I will be in bed the minute after the clock turns into the new year.
All right. Well, a lot of people in bed. We should point out volume is light here in U.S. markets here with just about an hour and a half until we get to the cash session. Let's check in on futures right now. Stock futures up about 0.2% on the S&P. Similar moves, quite frankly, on the other futures as well. The Dow, the NASDAQ, and the Russell 2000. An interesting punctuation mark here. For a market that is sitting on some really sizable gains. The S&P, Sonali, headed for its 5th straight quarterly gain, 24% rally on the year. That matches the gains that we saw last year was also about 24%. That's the best 2-year gain going back to 97, 98.
It's certainly a historic run we've really seen here, but we remember what happened in 97, 98. Going into the new year, you do have some jitters. The S&P 500 breaking those 3 days of losses, significant sell-off just yesterday. If you told me we'd be sitting here in the last day of the year and the 10-year yield was more than 10 basis points lower than where we saw it Friday, tremendous bond market volatility in addition to the stock.
And think about where it was at the beginning of the year or even a year ago. And it's kind of interesting, like, what is the most surprising story? Was it the record moves in stocks? Was it kind of the non-record moves in commodities? Was it what we saw in the treasury space? Was it just the VIX and the fact that it did nothing this year?
Or frankly, Bitcoin 100. Would you have put that on your bingo card after FTX and the way we bounced back?
I was ready to stop talking about Bitcoin earlier this year, and then all of a sudden it roared back here. Of course, now sitting on a 100% gain on a year-to-date basis. 100% gain the previous year. You got a lot of folks thinking it can match those gains here in 2025.
Certainly everyone's setting up for a new administration as well. And while there are some jitters in the bond market, you saw Bitcoin really tearing off the heels of this idea that the SEC will be a little lighter. We'll see. Everyone's preparing for inauguration. We're 20 days away.
A lot of catalysts out there that could move the markets. A lot to talk about in this final hour of Bloomberg Surveillance. Matt Miskin over at John Hancock going to be stopping by on why he sees limited upside for the S&P after 3 straight years of gains. Tom Fitzgerald over at TD Cowen is going to provide his 2025 outlook for the airline industry. In fact, airline and travel stocks have had a phenomenal year. And we're going to talk to former NYPD Commissioner Ray Kelly about keeping everybody safe as the city of New York gears up for those big New Year's Eve celebrations. The ball drop. Have you ever done the ball drop in Times Square?
I have not. I've watched it safely from downtown or uptown, wherever I've lived at the time.
Yeah.
I'm out of the city this year.
I was fortunate enough to actually see it before all the security really ramped up, before 9/11, before the Oklahoma City and all that, where you can just kind of come back and forth.
What year?
And kind of that. I'm older than I look, Shonali Bassick, so that's going to keep that close to the vest here. We'll not be going out tonight, but for all of you out there braving it, we wish you the best. We begin this hour, though, with equity futures sitting on modest gains. Stocks hoping to snap a 3-day losing streak here on the final trading day of 2024. The S&P having a wonderful year, a blistering year. The index up about 24%. Matt Miskin over John Hancock seeing a limit, though, to further gains, writing that it's going to be hard for equities to stomach much more upside. While we still prefer U.S. equities based on the better fundamentals, we recognize the magnitude of outperformance in 2024 is not likely to be replicated. Matt joins us right now to talk a little bit more about that outlook. And Matt, maybe we don't see the same gains we saw in 2023 and in 2024, but should we expect at least some meaningful gains in 2025?
It's certainly possible, Romaine, but what we're seeing here is heavy is the crown, really, for U.S. equity leadership and U.S. economic leadership, frankly. After a certain stint like this, where U.S. economy has just blown past most global economies, the U.S. dollar has strengthened a lot. So it's up about 6% in 2024. A stronger dollar makes us less competitive on a global basis. It helps actually bring down inflation because we're buying stuff from abroad. But it is difficult to stomach for economic purposes. Then rates have been higher. So we have high quality bond yields, 10-year yields higher on the year. That's a bit of a slowdown. And then there's massive expectations out of the U.S. economy and markets into 2025. So the earnings estimates for 2025 for the S&P 500 are still about 15%. So there's a lot of optimism. One of the biggest assets the S&P 500 and U.S. large cap stocks have had over the last several years has been conservative and more kind of bearish sentiment. Mm-hmm. The sentiment dial has been turned up significantly to end 2024. We think that's becoming a bit of a liability as we walk into next year.
Well, that's what I am confused about here. We talk about how crowded some of these trades are. We talk about the lack of hedging that we're seeing in the equity space, and the idea that you have valuations, at least for some of these companies, that, at least by historical standards, would be stretched. I know there are some people that want to reinterpret history, but what do you do in that situation? Do you reallocate? Do you stand by your conviction that maybe some of those stocks can go higher? What?
Yeah, momentum is not a fundamental factor, and momentum was the number one way to outperform, the only way to outperform, frankly, in 2024. So what is momentum? It means you look at the best performing stocks over the last 6 to 12 months, and you allocate the most to those. So basically, chasing performance was rewarded in 2024. But to your point, Romaine, there's other things that drive stock markets, whether it's valuations, whether it's earnings. And those parts of the market have been left behind this year. And there's a bit of a dogs of the Dow type formula where usually the worst performers can sometimes become the best performers in the subsequent year. This year, ending this year, the dogs of the Dow kind of mantra looks more realistic as a potential turnaround or catalyst into 2025 because we are so stretched on the valuations. We're at about 22 times on forward PE on the S&P 500. The highest in history, at least the last 30 years, has been 24. There's about 9% upside we can get on valuations. Earnings estimates are already great. Dividend yields are the lowest in history. So to your point, it's hard to eke out gains in the more expensive stuff. The better value stuff could come around. Sorry.
Why do you believe that in the essence of when you see sell-offs happening, you're seeing a lot of babies thrown out with the bathwater here? And if you believe that maybe some of these underperformers can come back next year, how much of a risk is there that just risk appetite alone goes along with it?
Yeah, that's the tide that lifts all boats and the risk appetite. But what we're seeing, look, is into next year, there's just hard to get more valuation upside on the other parts. It's not necessarily calling that they're bad companies, that they're going to see this, really bad performance. It's more just saying the multiples can expand in more like mid-cap stocks and small-cap stocks versus large-cap stocks. Internationally also has been really a tough performance year. European equities are only up about 2% in US dollar basis. They're very cheap still. So what we could see is just a rotation or even, I would say, downside protection because the valuations are so much more attractive. So those are the types. We're just trying to manage risk the best we can. And frankly, the high flyers don't look good to us because of the valuations. And part of the value space that's deep value, the earnings aren't as good. We're trying to apply quality at a reasonable price as our mantra into 2025.
So then is the best way to hedge the equity market, in essence, the equity market? Because if you're looking at the volatility in the bond market, is that really a place to go hide?
We think it will be into 2025. Inflation is likely to come down. Inflation is the nemesis of that bond market inverse correlation, really, that hasn't been around for the last year or two. But inflation has come back a bit to end the year. We think that's more sentiment driven. We do think that comes back down into 2025. And really, it goes back to housing. I mean, we're going to get some housing price data today. We're really dialed into mortgage apps, housing price data. Housing made up about 60 to 70% of the inflation narrative over the last several years. If that can slow down into 2025, inflation comes down, bonds act like bonds again. And if that happens, a balanced portfolio really can look much better from a diversification benefit standpoint into next year.
Matt, I want to go back to something you just said, which kind of startled me. One of the great things about having a Bloomberg terminal in front of me is I can kind of check everything on the fly. About dogs of the Dow. They were dogs all year long here. I mean, I was just taking a look at the dogs coming into this year. We're talking about underperformance by about, 25 percentage points relative to the S&P 500, just to use that as a comparison. And I'm looking at some of the ones that will probably be the dogs going into next year. I guess the ones with the highest dividend yields, like Verizon, Chevron, Amgen, and Johnson & Johnson, to say the least. I mean, some of these names were the same dogs coming into this year, and I am curious as to whether this is also about sentiment and attention. If all the attention is on tech and AI and other things, why should I expect anyone to really embrace a healthcare stock or even just a consumer staple stock or a telecom stock?
Yeah, so momentum, like I said, was the best performer, and all the other factors did not work. So you had to chase performance. If this is not a year of a rotation, it's got to be the 1990s all over again. So there's only been 3 other times where there's been 25% back-to-back gains like we're looking at here potentially. The only time it went 3 years in a row was in 1999. So we're going to have to kind of bring out the popcorn, watch maybe some Jurassic Park or Friends, or we're going to have to get our 90s culture back. But 1999, you got to be careful what you wish for, because if we do get that third year where it's just another momentum. year, it's going to be tough because then you got to be careful what you wish for, because then we got the last decade after that. So we would start to peel back that momentum trade and rotate into higher quality but value parts of the market.
I mean, one thing, though, too, about the comparison with the 90s, and a lot of people will make this comparison, which is the idea that in the 90s you were dealing with a lot of companies that just did not necessarily have the fundamentals to support those valuations. We talk about a market, and I checked it this morning, 70% of the gains, the point gains in the S&P 500, attributed pretty much now to about 9 stocks, basically the Mag 7 and a couple on top of that. But all of these are names that are just cash monsters: NVIDIA, Apple, Amazon, Broadcom, Meta, Tesla, Microsoft, Alphabet, JP Morgan, Netflix. Those are winners, man.
I agree. No, we've been overweight tech. We've got that, but it's just hard to see the same kind of return stream that we've gotten out of them into next year. You know, you can only do outsized return. There is reversion in the mean over time, usually with markets, and we are in the most concentrated market in history by a huge factor. So 40% of the market is just in those top 10 stocks. And I'm talking about the S&P 500. That's never happened before. It's never even been close to this high before. So reversion to the mean would suggest that at some point, those trillion-dollar mega cap companies have already built in the valuation to those great cash flows. I'm not saying, look, we've got it in the portfolio. We've got a bit of an overweight relative to other parts of the market.
Yeah.
But going into next year, chasing that doesn't make a lot of sense to us. Finding other opportunities across the portfolio, other asset classes, makes more sense in our view.
Matt Miskin over at John Hancock. Happy New Year to you. We'll catch up with you in 2025. And Shonali, it's kind of interesting, too, to see how the market rally has changed. On a year-to-date basis, 10 of the 11 S&P sectors higher. But when you look at it on a month-to-date basis or even a quarter-date basis, only 3 are in the green, and that's communications, discretionary, and technology.
Some of the dogs of the S&P are expected to be dogs of tomorrow, or the winners of tomorrow. Think energy, for example. A lot of people riding on that trade heading into the Trump administration.
One of the surprising performances on a sector basis this year was